University tends to be a very small aspect of economics. I've spent a long time in the world of macroeconomics, but not in the world of theoretical economics, but the world of real economics. What drives markets, what drives economies, and understanding those linkages. And one thing I've learned over time is that everything I learned at university was wrong. And not only wrong, but it's become more and more apparent that it's become dangerous, what we've learned. And we've learned to rely on too few economic ideas, and that in itself has driven global economies into situations we've never seen before. Now, the problem with economics is there's a lot of problems with economics, and most of it's because it's modelled and it's not based on the real world. And again, I'm going to go through a few quotes just to show you what people around the world think about economics. And I think this is a famous quote. If all the economists were laid end to end, they'd never reach a conclusion. I think that's fairly true. Ask 5 economists, you'll get 5 different answers. 6 if one went to Harvard. I think that's true as well. Years ago, I noticed one thing about economics, and that is economists don't get anything right. And I'm going to address this about one of the reasons they don't get things right later. And again, it's this thing to do with modelling. I'm not an economist, and we all know economists were created to make weather forecasters look good. I felt for some time that economics needs to be taught differently by economists who actually have experience making a payroll investing on Wall Street. When economics is taught by pure academics, watch out. And this is partly slightly tongue-in-cheek, but it really is important for you guys to realise that everything is changing and there's kind of a revolution ahead. And you guys are at the forefront of that, and you can make the changes the world needs, and they actually need change. It's not a glib statement. We actually need some really big changes to how we understand how economies work and how that interaction works with finance and down at human level as well. Now, the problem is, for me, is that we have only 2 schools of economics that are taught with any depth now. Now, I know we have the kind of neo versions of all, but the only reasons we have neo is because the original versions were deemed not to work properly. But the thing is we've heard it again from the speakers over the last day and a half. The same thing is this pretty bipolar, or it's a combination of the 2, is basically there are 2 schools of economics that only get used by the central banks and only get used by the mainstream economists, only gets used by the main Wall Street firms, mainly picked up by the media. And so what we've got is this kind of self-fulfilling group of people who want everything, and those things do not work and prove not to work, yet we continue to say. The first one is the most obvious one, Keynesianism. Keynesianism really came about, as we all know, out of the 1930s crisis, and was one idea of the way of dealing with the crisis. Keynes kind of won the battle against Hayek for reasons I don't understand, but that's where we come today. Keynesianism has a whole number of key elements to it, and again, I'm not here to argue in depth about economics because economists have been doing this forever and nobody ever reaches a conclusion. All I want to get in your minds is maybe these aren't all economic truths, that economics is not a pure science, it's more of a social science or even really an art. And if we understand that, then we have a much better understanding of how economies work and how economics works and how we can manage economies, or whether we should manage economies is another broader question. The simplest level is the Keynesians think that they need to spend their way out of a crisis. And that works in the ordinary course of events, that works pretty much okay. Sometimes it doesn't, and it doesn't when I'll come on to that in a minute. There's also something called the multiplier effect that we all learn about, which is, if the government spend money, then that money gets into the economy, and that money moves through the economy and helps stimulate overall demand. And then there's other things about interest rates, and if interest rates fall too far, you get liquidity traps, and there's all sorts of bits and pieces that get bolted on to Keynesianism over time to address issues that didn't quite work or didn't quite fit in the real world, and we get the kind of the neo-Keynesian stuff that comes out of it. But the issue is we live in the real world. We don't live in that model-driven world, and if you ever try and read any of Keynes's stuff, there's a lot of economic formula there, and again, much of it is inapplicable. Basically, the things that you need to get across, and again, you don't need to be the smartest man in the world to realise that if you are too far in debt, You can't create more debt without causing a crisis. And this is a simple thing that we forget time and time and time again, is you can't spend your way out of a crisis if you're very far in debt. If you don't have much debt, then of course you can. There's no problem with that, and it does create some demand. Does that demand trickle through the rest of the economy? That's very debatable. But at this level, the simple thing is you ask Greece or you ask Argentina to try and stimulate their economy fiscally, they can't do it. It's impossible. And the reason it's impossible, because the real world, the people who actually finance these economies, will walk away from financing it because they say you're spending more money. Even though you think you're going to generate economic growth in the future, the reality is you may not, and I don't want to buy your bonds, and I don't want to buy your currency, and I don't want to buy your stock market, and that leads to economic crisis. And that happens repeatedly over and over and over and over again. And the problem is the amounts of debts that some of these economies are holding right now are so vast that it's very difficult to see how they can actually do anything meaningful. China's the last great example of this. I mean, China, after 2009 or 2008, started an enormous stimulus package, which was basically spending money. Now, China's got to a point where it cannot really borrow any more money, and my view is that China's about to have a currency crisis of its own, whether it's derived from international pressures or internal pressures to not revalue against the US dollar. The other thing is the multiplier effect, as we talked about. You know, if you spend money, it's going to come back into the economy and everything's going to get good. But we've seen time and time and time and time again that this doesn't work. It can work, it sometimes works. But in extremis, if we look at Japan, Japan has spent so much money on fiscal stimulus over the last 18 years or so, and they've got absolutely zero to prove for it. So yet we still continue to believe that spending money using the fiscal process and building bridges to nowhere and roads to nowhere works. It doesn't. It works sometimes. It may work in conjunction with other things, but it's certainly not an answer. Because what you end up with is, again, the same idea is you end up with too much debt and you end up with a crisis. And crisis, you need to understand crisis. We've just come through one, so it's great for us because we have kind of fresh in our minds how that works. And we're still not through that process because global debt is the highest it's ever been in world economic history. I think global total debt to GDP is still something like 350% of world GDP. The world has never seen anything like this before. And the actual truth is, if you actually sit down with the people at the Fed or the people at the Bank of England or many of the what can you really do about this stuff? They actually will honestly off record answer you, I don't know, we're just making it up as we go along. And that is the problem. If you make things up as you go along, you end up with a bigger problem. The other thing is the Keynesians say, well, in conjunction with fiscal policy, we need a monetary policy, we need to run a loose monetary policy. Okay, but that's a problem now, and we've proven why this doesn't work because interest rates have got to zero. We're now getting to negative interest rates. This has only once ever happened, as far as I know. That was Switzerland, maybe 20 odd years ago. But now we've got, today, Sweden's just joined the group of countries who have negative interest rates. I mean, if you can fathom that, that is, you are now paying governments to lend them money. Is there any sanity in that? What is the probability of you losing money over time? Obviously 100% because you're paying somebody, but in addition, the chances that there is something really warped within the financial system needs to be taken seriously, and it's warped because of what we've done. And what we've done is use a blend of schools of economics that haven't really worked. They've kind of blinded us. Now also what's become incredible is it's not only governments that are now seeing negative interest rates. I think Nestle is the first company in the world to now actually receive money for people lending them money. So it's all screwed up. So if you want to lend Nestle money, you actually have to pay for the privilege. And the reason that is because people are desperate to find a safe place for their money. That's the real world. The real world is people do not trust what is going on and understand that there are some extremely dubious measures being taken and dangerous measures being taken that mean that the probability of bad things happening is reasonably high. And that is one of the things we need to understand is how people react is very different to how economic models tell them they should react. So in the summary, and as I said, a very glib summary of the whole thing is in the real world, in extremis, where we are now, we're truly in extremis, is Keynesianism doesn't work at all. At all. Yet we continue to follow these policies. We heard from the ECB yesterday evening is, what we need to do is we need to still stimulate interest rates and lower interest rates, and then we'll try and fix the mess of what happens to the financial system, because the financial system gets carried away and takes all this free money and speculates wildly with it. But we'll kind of fix that in the meantime and hope that doesn't blow up again, and we'll try and regulate it, even though we don't have the ability to regulate it for the legal framework. But what we'll do is we'll keep with this interest rate policy because that's going to work. Where's the evidence? Japan has been undertaking quantitative easing now for best part of 15 years, and they've had zero response from it. The other thing we get is monetarism, and it's been out of favour, much more out of favour in recent times, but it's still prevalent in people's thoughts. And what's happened is we've started to get this blend of monetarism and Keynesianism, because everyone knows kind of neither kind of works, so we'll just bolt everything together and hope that works. And that's become even more dangerous. With monetarism, it boils down to the famous equation MV equals PT, and also inflation is always and everywhere a monetary phenomena. Again, I really am nervous as a practitioner in markets and a practitioner in the real world of economics. I'm incredibly nervous of using formula. Yes, they can give us some understanding of how things work, but in the real world it just doesn't work that way. And I think that's the point, is we need to move away from these equations in economics. They add some value, they add some discussion, and discussion's good, and us trying to get an understanding of economics is certainly a good thing. But what we can't do is just believe that in an equation that we're going to find the answer to how humans behave. That just doesn't work. The other thing with monetarism is we've tried this kind of quantitative easing. And what we found is after 6 trillion, or with the number today was 7 trillion, it still hasn't worked at all. What we can't do is dictate what happens to that money when it gets into the system. Now what's happened is basically all of the money that came into the system via quantitative easing basically stayed back on the Federal Reserve balance sheet, for example. It didn't go back in the system because there's no velocity of money. People don't want to borrow money, and so what you've got is a world where monetary policy just doesn't work. And you can't also influence inflation expectations. We saw several people talk about inflation expectations and how they're falling, and it's kind of puzzled people. Well, that's the problem is again, because we're using the wrong framework. We're kind of expecting some blend between Keynesianism and monetarism to create an understanding of what drives inflation, when we actually don't really know what drives inflation. I have a much better idea by using some practical applications, which I'm going to talk about a bit in the seminar later. But basically, inflation just follows the business cycle. So it's not, you don't need to model it as much as just understand when it goes up and when it goes down, and whether it's secular or cyclical. And secular disinflation, or is now becoming deflation, is a big feature. And what has been proven, absolutely without a question of a doubt, that we can't control that. So everything we're taught about, you can regulate inflation, it's always everywhere a monetary phenomena, it's just not true. It may be theoretically, it may be not an extremist, but in extremis, it's not working. The other thing about things like inflation is it doesn't always relate to money and the amount of money in the economy. It relates to demographics. And you can see it, pretty much any country that's got young demographics ends up with higher rates of inflation. And why is that? And that generally comes from things like, well, if you think you guys are all, in essence, like a small baby boom group, we can use you as an isolated example, because you guys are all going to go into work in the next 5 years. And as you all go into work, you're going to buy your first suits, your first apartment, your first table, your first chair, your first this, your first that. So what you've got is an enormous amount of demand that you take on board very quickly. You're buying stuff. Now, when you've got a huge boom in population, you end up buying a load of stuff. So the baby boomers bought lots of stuff all at the same time. And what does that do? Create inflation, obviously. And so demographics is a much bigger part of economics than the economists play anything to. And the reason being, because you can't model it so easily. And so that's the problem is when we go back to the Chicago school and what they looked at in inflation is they basically took the 70s and took that as economic history and some of the 1930s and said, well, that's how it kind of works. And that's not true, because if you take spurious correlations, you get spurious results. And they took some spurious correlations, because we now know that virtually nobody uses money supply as a gauge of inflation, but a whole school of economics got built up on it. But it didn't work after a while. And I'll come into why some of this stuff didn't work. The other problems with the theoretical world that we come across is these words, and you'll have come across these all the time. Exogenous and endogenous, ceteris paribus, perfect competition, and efficient markets, they're all total bullshit. Because what they all mean is one thing: this doesn't work in the real world. And that is a problem. And again, I'm not belittling economics. You know, it's all very important, and I believe the answer lies in a much broader basis. But the point is what we're taught doesn't apply. So let's have a look at the mess we've got ourselves into. So what we've done is we kind of used a bit of this and a bit of that, and then we went to extremists on all of them. And what we ended up was, and this is just the US, and this chart's a bit wrong actually. So this is the chart of US total debt to GDP. That's not just government debt, because we need to use total debt because we learned that all debt is basically de facto government debt in extremis. So when banks go bust, the government has to bail them out. If the people go bust, the government bails them out via fiscal stimulus. Now, it's a bit of a cheat here because it looks like the debt's come down, but it's not. And that's because of a lovely thing, which is the US decided to redevise how it calculated GDP. And what it did was magically lower their debt numbers from 90% of GDP at the government level to 70% because they changed GDP. So this fall is not true, actually. It's actually remained about stable, or if not, has increased. So what we've got is an economy. You need to understand what this means. I mean, these are numbers you hear, percentage of GDP, kind of means nothing to you. What it means is the US is 100% of world GDP in debt. No economy in world economic history has run debts of this scale. It is beyond anybody's imagining. Now, if you look at the chart and the rate of change, and again, in economics, rate of change is an important thing for us. The rate of change was pretty slow. Debt. We came out of the World War II, and debt slowly built up because most debts got wiped out after World War II, and the currency devaluations, all the things that happened. And then what happened is nothing for a long period of time, and we had a reasonable amount of economic stability. In fact, we had boom years with the highest economic growth that we had seen in 100 years coming out of this period. We also, at the time, we didn't have the free-floating currency regimes that we have now. We had the gold standard, and the gold standard has many pitfalls, but one of the benefits was it kept inflation pretty stable, and it kept the business cycle, even though it looked violent, we didn't build up imbalances because we couldn't do. Because what happened after this period here was we walked off the gold standard, and basically we could print money and we could create as much debt as we wanted. And that was when we started the mix between the supply side guys and the Keynesian guys and the monetarists. And everyone started piling bits and pieces on to win votes. So economics and politics are very closely linked. But that happened. So the Reagan years, small government, we won't spend much. Well, the acceleration of growth in debt was phenomenal because households piled on debt and corporations piled on debt and the government piled on debt. And then it continued and continued and continued. And it exploded all the way up into the crisis. And this is all because we believed certain falsehoods. The falsehood that you could spend your way out of a crisis to smooth the economic cycle. All it does is increase debt. We've only really been doing that over this period, and this is what we've done. The other big fallacy is that we can cut interest rates and manage the economic cycle via interest rates. Monetary policy. Monetary policy has done nothing but increase debt. It has made people's propensity to increase their debt load much higher because they suffer the money illusion where they think that money is cheap, but it's not. So this is the big problem we're coming to, is we're coming to a world where we are just doing the same things and hoping that we get a different answer. That's what's staggering to us market practitioners, people who are involved in this on a day-to-day basis. And if you speak to people who run hedge funds, who work for who work outside the investment banks or the main kind of sphere of economics, we're all saying, listen, what you're doing is very, very dangerous. It's so dangerous that Greece and Cyprus and these countries are an example of what could happen to the rest of the world. I truly believe that we've got one of the largest financial crises still ahead of us because we refuse to get rid of debt. We continue to think that printing money to buy debt is a way of creating a stable platform for growth for the future. The central banks, I've sat down and spoke to many of the people at the Fed, and they say, listen, we just hope it kind of figures itself out in the meantime and we don't have a crisis. And in that case, maybe we'll be okay, but don't worry, I'll be out of a job in 4 years' time and somebody else can worry about it. And that's the kind of mindset that's there because nobody knows what the hell to do with this. So this is why I'm getting very concerned and the market participants are getting concerned. And I think people really need to learn about new things. And so many of these are things that have been around for ages, but you've all given up learning. And I don't understand why. Business cycle theory, this is the thing that I look at, and I'll come on to business cycle theory. It's almost forgotten since Schumpeter started writing about business cycles a long time ago. And for me, business cycles is the easiest way to understand economics in the world. Austrian economics. If we'd adhered to some of the tenets of Austrian economics, we would have never had this problem in the first place. The idea that you don't build up imbalances, you don't try and manage recessions, let them come naturally with an ebb and a flow. And you can see that. Singapore is a great example of a country, and Hong Kong, that allows that to happen. They don't really manage their interest rates to manage their economies. They let recessions happen frequently. And what happens is they get relatively light recessions. If they happen to get caught up in a global recession, it's going to be bigger. But their recovery is quick because they don't have this massive debt imbalance that everybody else has built up. And that's the problem. There's classical economics and there's a lot of stuff from a long time ago that has relevance that we've all forgotten. The other thing that I think is really exciting right now is behavioral economics. It's deemed the new thing, and I think rightly so, because it doesn't model people as much as make an understanding of how we all work as individuals, and that we don't follow the rational ceteris paribus rules that we're all taught we should do. We don't. We act differently, and we're incentive-based people, and we need to understand what those incentives are and how they work. And as soon as behavioral economics gets wrapped up into macroeconomics, I think we're going to make some real progress in understanding how it works, because behavioral economics is basically the economics of the real world. Game theory is incredibly important as well and long forgotten. But if you look at the world in game theory terms now, in terms of currency wars that we hear about, or what's happening with Russia and geopolitics and that juxtaposition between geopolitics and economics, that's all game theory. And game theory gives us a really good idea. Why most economists don't like stuff like business cycle theory or behavioral economics is because it's all about probability theory. It's the understanding the probabilities of recessions or the probability of this or that happening. That's how the real world works. That's how investors work. We assign a probability to a certain outcome and we shift our probabilities as the facts change. What we don't do is say, well, here's our model and this always predicts this, because that doesn't work. There's also liberalism, modern monetary theory. There's a whole host of stuff that's out there that you guys need to spend a lot more time understanding. If you listen to people like, I think of great, like Lee Kuan Yew, who was the father of modern Singapore, he believes in Hayek and the Austrian School of Economics. Many of these kind of small, open economies look at the Austrian School of Economics, but nobody else did, because these guys wanted to win votes. I mean, it was lucky for Lee Kuan Yew that he was a benign dictator, so you don't need votes, but it did work, and Singapore has grown incredibly well because of it. Hong Kong does the same. So anyway, so it really is for you guys to start understanding that there is stuff that you need to look at. So what do I do? What do I look at? Because I call myself an economist, but I certainly don't adhere to most of the schools of economic thought. What I do, I'm kind of a practical market economist, and I use a blend of stuff. So I like business cycle theory. I like economic history. I think that's one of the most underrated things of all, is understanding history. And I think Rogoff and Reinhardt's work on debt and stuff is all about economic history, because basically people do the same thing all the time. They make the same mistakes, and that's part of the behavioral economics. And I also blend a bit of Austrian behavioral, Keynes, monetarism, and liberalism, throw the whole lot together, and most importantly, I try and use some common sense. and understanding the real world. I know it's not common sense for me to have to pay to lend Nestlé money. That kind of thing is not common sense. That's stupidity. So what do I mean by the business cycle? And this is why I'm just trying to throw some things out there so you can get a better understanding of what I mean by how we can look at the world in a different way. The business cycle is a really simple thing. It's been around forever. In fact, there's evidence of the business cycle going back to Egyptian times. What we know is there's a boom and a bust that goes on in the economy, and it always goes on, and it always has gone on. And sometimes it's related to agriculture, other times to the industrial production cycle, and other times to the credit cycle. It almost doesn't matter what it is that drives it. What it is to understand that it happens. Because look at this. One thing you know is after a boom, you get a bust. That is economic fact. The question is how long it takes and the path it does it. But these kind of things mean that you've got a probability. What's bizarre to me is economists never forecast recessions. It's incredible because what they do is extrapolate a linear growth rate because they don't understand a simple thing. And I'll prove to you that there is a business cycle because there it is. That's the business cycle of the US economy going back to 1947. You can see the gold standard period, ups and downs. But what we actually found is economic growth was about 5% over that period. Then we had the big inflation crisis here, the double dip recession. And then after this, we abandoned the gold standard altogether. Well, around here, we abandoned the gold standard. We paid for it then. And then after that, we've got these longer periods without recessions and a very small recession in 2001. Now, the reason being why this happened was because of one thing, is we tried to manage the economic cycle. So a central banker would look back and go, that was brilliant, look what we did. But what we know is that debt exploded from like 100% of GDP to 350% or 380% of GDP. And that's all we did was smooth it out by debt. So that's the current cycle, and I'll show you what that means is because that's GDP. So what you get is the year-on-year GDP, the rise and fall, and actually GDP is coming back down here again now. It's slightly noisy. Firstly, to notice, this is the lowest ever economic recovery in GDP in the history of America. It's also the lowest economic recovery in GDP in the history of Europe, the history of Japan, and pretty much any other nation that I can find. It's the lowest ever recovery, which we learned about in the previous lecture, how bad things are. There's a massive disconnect gone on. Now, what we know is from the last chart, we know that once we've reached a peak in the cycle, the next thing that's going to happen is going to be a trough in the cycle. And we know within a certain probability the time period that's going to be. Obviously, it's not a clear probability. It was easier then, less easy now because it's got a bit convoluted now because we're hitting crisis mode and we're unwinding the debt bubble. But we do know that the next thing is a recession, but yet not one economist could forecast a slowdown in economic growth in 2015. Not one single economist out of the 90 economists on Bloomberg would suggest that the probability is, not even for the economic growth to go to recession, but even to go slower than last year. Everyone thinks it's impossible. Yet I would say the probability is reasonably high. This is the difference between real-world economics and theoretical economics. So the thing is, what we need to do is we need to question more. We need to say, okay, well, why are you telling me that? Does this really work? Are you sure it works? You've got to be a bit cynical to understand how the world works, because if not, we all kind of take the hopium and all believe that all of these things are the answer, and they're not. If we stop believing economics is a kind of mathematical-based science and realize it's a social science or an art, we'll make much more progress. And you guys are the people who can make the progress. I got so fed up with this whole thing, and so many people in the financial marketplace got so fed up with what is happening, what the central banks are doing, what the governments are doing to economies, and how dangerous and risky and scary we think we are, that I decided to do something about it. So one of the things I thought is, there's no point, because there's people like me who write economic research, and most of us kind of all say the same thing, is things are really, really scary, and anything could upset the apple cart. The next recession could be the time when the entire world's financial system goes. We just don't know. Maybe it doesn't go, but the probability is there. And we're fed up with the same policies being pursued and pursued and pursued. So the answer seems to be for more debt is to create more, of too much debt is to create more debt. that doesn't make sense, but yet that's what we're doing. So what I decided to do with a few friends of mine was start a television company, which was a video on demand company called Real Vision Television. And the idea behind Real Vision was to actually bring the real world to everybody, as opposed to just somebody like me who writes it to elite hedge funds and some central banks and some ultra high net worth family offices and stuff. The idea is we need to bring economics and investment to the real world again. Let people understand, particularly students understand, a much broader range of what's going on, and let you guys make your conclusions. I don't want to make any conclusions for you. That's not my job. My job is for you guys to broaden your idea and realize that something out there may give you some answers to develop your own schools of thought, because you guys are going to be the policymakers and you guys are going to be the central bankers, and please, you've got to learn something that what we're doing now doesn't work. So it's all up for you guys. It's an opportunity. It's a revolution is out there for economics, and particularly for economics students. You've got so much you can do. So what I'm going to do is I'm going to show you some clips from Real Vision Television, and it's not to promote the thing. It's just that there's some interesting clips of what people are saying, so you understand these are market practitioners, and what they're saying is very different to what you hear. So let's give it a go and see if this works.
And she leads the largest women-owned business in the U.S.
Watching that they're coming in. That is unbelievable.
The truth hurts.
Debate night on CNBC starts at 6 with a live Mad Money special.
Here's the Dow Jones Industrial Average down about 40 points.
I think I'm just crazy.
The market doesn't seem to want to think for itself anymore. When you watch what happens whenever either an ECB or the Bank of Japan or you've got the Fed person gets up on TV and the markets start immediately reacting to it. When the hell did the stock market movement become perfectly correlated to words coming out of a central banker? They're not supposed to drive the economy or the stock market, and yet now they do.
We've had this 30 years of lower lows, lower highs, and a whole lot of nominal variables. I thought it was going to end in 08. The banks and other policymakers avoided the worst. But even then, I thought there's only one thing worse than Mr. Bernanke failing in what he's trying to achieve, and that's if he succeeds. That means we go another leg, and as we've seen, we had a crisis in 08 caused by rates too low, too much debt, mispricing of risk. The policy response has been lower rates, more leverage, and another round of mispriced risk. I think the next downturn, whenever it comes, and that's unclear, will be monumental and very nasty for holders of risk assets.
What Wesley Mitchell did was define and understand what a business cycle is. It's not a number, okay? It's really a process that happens in free market economies where there's some endogenous, inherent cyclical ups and downs, fluctuations that join with shocks, kind of unpredictable shocks. And it's the combination, actually this is one of the key insights of our work, it's the combination of the endogenous cyclical forces, kind of the ebb and flow of a market economy's activity with shocks that gives us recessions.
The source of demand is production. Therefore, true demand is always and everywhere equal to production. For example, the shoemaker will be able to sell all his shoes at some price. Now, it won't necessarily be the price he prefers, and it's possible he will take a loss, but at some price, the market for his shoes will clear. And the capital he receives in exchange for these shoes will constitute the shoemaker's demand for other goods. As such, production and demand will always be equal, and likewise, the two can never be out of balance. This is a key mistake for followers of Keynesian economics, which is far and away the most widely followed form of economic thought on the planet. It permeates the status quo and is the de facto program espoused by business schools, central banks, commercial banking institutions, and governments the world over. Keynesians believe that recessions are caused by overall supply and demand for goods being out of balance, causing a general glut. By the way, don't even try to figure out this chart. It was created by Keynesians and it doesn't make any sense. And if you can't explain something in a simple matter, they probably don't even understand it to begin with.
Politics always trumps economics. And what I mean by that is that the human animal is a social animal. And you really do, I think, have to look at patterns in history that stem from politics. It always comes from politics that rewrites the rules of economics. And sometimes that rewritten rule can work to your benefit. More often than not, it's a shock and works against the pattern that you're used to. I think it's so important to again, look at history, look for these patterns, and as best you can, have a sense, at least, of what I call your risk antenna.
I think what I spend most of my time trying to figure out is how the global economy can generate enough income to service and repay the $100 trillion plus dollars, euros, yen, yuan, renminbi of debt that it's incurred and that's sitting on the books of governments and private sector companies. And the conclusion I keep coming up with is it can't possibly do so.
You don't pick winners, you avoid losers. And if you can avoid losers and diversify amongst the rest, that's really 4/5 of the battle. And you know, as a simple example, if you came in 1980 and decided, you know what, I'm just not going to invest in commodities, you could go sit on the beach in the Caymans for the next 10 years. Then you came back in 1990, said, you know what, I'm not going to buy Japan, and you diversified amongst the rest, you could go back to Little Cayman. And then you came back in 2000, you said, I'm not going to buy tech, and that was fine for 5 years. And in 2005, you came back, you said, I'm not going to buy banks. And so basically 4 decisions in the space of an entire career. And if you made just those 4 decisions, you were one of the most successful money manager to be.
Analytical thinking is about finding a solution. And if you talk to economists, they often try to find a solution to the world situation. They give you a forecast. They tell you what is really going on with unemployment, what is really going on with budget deficit. And even worse, they're telling you what is going to happen in the future. And as we know, predictions don't really work. But that's the job. They're trying to solve. You ask a person, where do you think euro will go, up or down tomorrow? And they're trying to solve that problem. They look at economical indicators, at market flows, at charts, and they're trying to solve it. That's not actually strategical thinking. Strategic thinking is all about a system of responses. It's all about strategies which could be actually agnostic to the solution.
What I'd like you to do, and what I wanted to achieve by doing this presentation, was just to get this on your radar screen. You just need to start thinking about these things, because it is probably a complete change to everything you've ever been looking at, because we've not had to worry over the last 8 years about what the dollar's doing, or the euro's doing, or the yen specifically. We've not had to worry about any of these things. We've not had to worry about emerging market risk per se. We've not had to worry about carry trade risk. We've not had to worry about yield risk in different markets. And I think a lot of these things that we hold dear as the safe haven trades or the easy trades are going to get blown up, or certainly at risk of being blown up. So I think if I leave you with one thing, I just say, listen, hopefully I've opened up some. Stay focused, because this shit's really real. So you've got a vague idea of kind of some of the people that we're interviewing, people from around the world, the big hedge fund managers, the independent thinkers, and everybody else. And what comes across, I think, from all of that is that these are really uncertain times, and that we need to broaden how we think about stuff. And I guess the answer there is the future of of economics lies in your hands. We don't have to listen to what we've been taught. We can create a new future for economics, and that will give us a better future for the world. And so it's all down to you guys.